Next question. XYZ Limited is investigating the acquisition of Shivani International Company, whose balance sheet is given as follows. Preference share capital is given 1 lakh, equity share capital is given 3 lakhs. The company has issued 30,000 equity shares. Reserves and surplus is 1 lakh 50,000. 14% debentures is 80,000. Current liability is 1 lakh. Total is 7 lakh 30,000. Fixed asset 2 lakh 75,000. Investment 50,000. Current assets is consisting of stock, debtors, cash bank. XYZ Limited proposes to offer the following to Shivani International. So first is 10% convertible preference share of rupees 1 lakh in XYZ for paying 10% cumulative preference share capital of Shivani International. 12% convertible debenture of 84,000 to redeem 14% debentures of Shivani International. 1 share of XYZ for every 3 shares held by Shivani International shareholders. The market price is 42. After acquisition, XYZ Limited is expected to dispose of the stock for 1 lakh 50,000, debtors for 1 lakh 2,000, stock for 55,000. It would pay entire current liabilities. First part of the question. What is the cost of acquisition to XYZ Limited? Second part of the question. If XYZ Limited has required a return of 20%, how much should be the annual after-tax cash inflow from the acquisition, assuming a time horizon of 8 years and zero salvage value? PVIF at 20% for 8 years is 3.837. I request all of you to just go through the question and then we'll have the discussion of the answer. Now friends, in the first part of the question says that so you're required to compute the cost of acquisition. What does it mean, friends? It means that say we are required to make the calculation of present value of the cash outflow, and the same will be compared with the immediate cash inflow. Present value of the cash outflow will be compared with the immediate cash inflow. And difference of both of them is the cost of acquisition. This is what we are required to make the calculation in the first part of the question. It means that what is the amount of the excess consideration that we pay for acquisition of the Shivani International, that is the target company in this example. I request all of you to make calculation of the cost of acquisition and put your answer in the chat box. So friends, over here we can make calculation of answer like this. Everybody is requested to pay attention. See, as per the given information, we are going to issue the preference share capital, that is cash outflow. 10% convertible preference shares of rupees 1 lakh in XYZ Limited. For whom? For 10% preference share capital of Shivani. So the cash outflow is consisting of an amount of 1 lakh. 12% convertible debentures of 84,000 to redeem 14% debentures of Shivani. So this is again cash outflow. Next, 1 ordinary share of XYZ for every 3 shares held by Shivani International. So what is exchange ratio? 1 by 3. The market price per share is rupees 43. Dear students, we can see that the number of shares of the target company are 30,000. So 30,000 into 1 by 3, it comes to 10,000. Into market price per share is rupees 42. So 10,000 into 42, that comes to 4,20,000. Okay, so we understand that say this is what's the cash outflow. Further, we understand that say the immediate cash inflow is stock. Immediate cash inflow is the debtors. Immediate cash inflow is the investment, and we will make the payment of the current liability. So payment of current liability is outflow, stock, investment, debtors, cash, all these are cash inflows. Outflow, inflow. You will make a comparison, and of course the outflow is going to be more, and the amount by which the outflow is more is cost of acquisition. I request all of you to write down answer. First point, cost of acquisition means excess consideration paid by XYZ to Shivani International right now. Second point, it will be calculated by comparing present value cash outflow and immediate cash inflow. Write on working note number 1. Calculation of present value of cash outflow. In that, issue of preferential capital. An amount of rupees 1 lakh. Next is debentures. It is an amount of rupees 84,000. Next is equity share capital. In that case, it is 30,000 into 1 by 3 into 42 rupees per share. That comes to 4,20,000. Next is payment of current liability. That is an amount of rupees 1 lakh. The current liability is 1 lakh. Afterwards, we have been provided with the cash inflow information. So, working note number 2, calculation of immediate cash inflow. In that, we understand stock, rupees 1,50,000. Debtors 1,02,000. Investment 55,000. That is the immediate cash inflow. Difference of both of them is cost of acquisition. One more thing, that is cash balance. It is an amount of rupees 65,000. So friends, you can see that we have considered stock, debtors, cash, investment. As far as the fixed asset is concerned, it will not be taken into account. Why? Because we understand that using those fixed assets we are going to do business. That is the reason for the time being we'll take the fixed asset value as 0. Okay. So difference of both of them is the cost of acquisition. So we will have working like this: 1 lakh plus 84,000 plus 4,20,000 plus 1 lakh. It is 7,04,000. So it is present value of the cash outflow. Afterwards, we'll make the computation of the present value, immediate present value of the cash inflow. 1,50,000 plus 1,02,000 plus 55,000 plus 65,000. 3,72,000. Immediate cash inflow. Okay. Next is cost of acquisition. It is immediate cash inflow minus present value cash outflow. So it is 3,72,000 minus 7,04,000. So excess amount is 3,32,000. And that is considered to be the cost of acquisition. First question answer. I want you to give answer for the second part of the question in the chat box. So friends, in second part of the question, we are required to compute that what should be our annual cash inflow so that we will be able to recover the investment at the rate of 20% return. So what will happen? It is year 1 to year 8 cash inflow. Let us assign X variable to it. It is discounted at the rate of 20%. 20%, 8 years factor summation is 3.8372, which they have provided to us as an example. The last year cash inflow is 0. In a way, that's the terminal value of the machinery is 0. So we understand that the present value is 3.8372 x. So this is present value of the cash inflow, 3.8372 x less investment. This is the amount of the investment, 3,32,000. And taking NPV 0 will make the calculation of X as balancing figure. We know friends that discounting a cash flow series at a rate, and if at all the NPV 0, it means that the return is equal to the discounting rate at which cash flows are discounted. So accordingly, the X will be calculated as balancing figure. Whatever the answer that we get is the amount of the annual cash inflow which XYZ Limited should be able to earn from the business, should be able to get from the business. Only in that case it will be able to get the return at the rate of 20%, and it will be sufficient set to cover up the investment of the project. So return answer. NPV is present value of cash inflow minus present value of the cash outflow. So 3.8372x minus 3,32,000. 3.8372x is equal to 3,32,000. So x is equal to 3,32,000 divided by 3.8372. Dear students, it is mandatory to use the factors which they have provided for the purpose of doing answer. So annual cash inflow is 86,521.42. So if at all the company is able to generate the annual cash inflow exactly of this amount, then the return is 20%. If the annual cash inflow is more, then in that case the return will increase. And if it is less, then the return will fall down. That is the way we are required to understand the answer. So, a summary for the entire answer. First of all, the cost of acquisition means the immediate excess cash outflow. So, whatever we have paid, and there is maybe some disposal cost information given to us, immediate cash inflow, excluding the sale value of the fixed asset because that you will not be able to receive. So, this is the cost of acquisition. The annual cash inflow so that you get a return at the rate of 20%. And accordingly, we get the answer.